Hello everyone, welcome to Washington Wealth Academy. My name is Donte Washington, and today's topic is real estate financing. With real estate financing, one of the things we're going to talk about is what we call a mortgage. Some people might not know what a mortgage is, and a mortgage can be, it can carry a couple different names: a lien, a loan, a debt, a couple different things that people might call it. Let's talk about what a mortgage is. A mortgage is basically a relationship between a lender and a borrower. The borrower basically needs the money to purchase a piece of real estate, but basically the borrower has to qualify, and the way you qualify is usually credit and income. Your income has to be pretty strong if you want a whole lot to spend on a real estate purchase. And the way to qualify in reference to income is working at a job for at least 2 years. When you're at a job for at least 2 years in most states, that's when you qualify income on the income side of things for a mortgage. Credit is another important factor when being approved for a mortgage. Your credit usually has to be a 640 or above to be approved for a traditional mortgage, but some lenders can go as low as 580. And that really depends on what's on your credit report. Your credit might not be that strong, but if you have clean credit, no debts, no collections, stuff like that, but you have strong income, then sometimes you can still be approved for a mortgage. So it's different type of mortgages, especially if you're doing a traditional deal. You got your FHA mortgages, you got traditional, and you even have VA loans. Something really unique right now that's happening with mortgages in America, and if you notice, the interest rates are rising. And it's not just mortgages, even on loans, just inflation period, things are up. So if buying a home and getting into a mortgage is something you're considering, just take into consideration that your interest rates are high, so that makes your monthly payments higher than they are traditionally. So even though the home might cost a certain amount and you're looking at how much it is monthly, it could be based on your interest rate is what's making that payment higher than it has to be. So basically, if you purchase the home and you're comfortable with the rate is right now, take into consideration that in the future, you might be able to refinance your home, and that actual monthly payment can come down even lower. And that can really help you, long term when it comes to your monthly payment. Even though people think interest rates are super high, in the past, let's say 1980 to 1982, I did some research and I noticed that interest rates were almost as high as 19%. So right now, what we're seeing, we consider it high, but some people have mortgages right now where the interest rates are over 10%. So even though they're high right now, we just seen like record lows last year, the year before, where people were getting mortgages as low as 2.4%. So keep in mind that these interest rates are still at a good space compared to where we were in the past. And if you can handle what the monthly payments are, and you can really do the numbers and look at what you're, dealing with overall, it might not be as bad as you think. Traditionally, if you're getting like a FHA mortgage, you're going to hear a term called PMI, which is private mortgage insurance. Private mortgage insurance is actually an add-on to your monthly payments. So that's something you want to really consider and pay attention to, because PMI at some point in your loan can be removed, but it's actually put in place for the lender. So it's protecting the lender just in case you default on your mortgage. And the reason why it's put in place, because when you're a FHA first-time home buyer, you're only putting like 3.5% down, something of the sort, and that makes you a high risk. So that's basically, your loan is like a high risk loan because you're not really bringing a whole lot to the table. And a lot of times with investors, they're bringing like 20% down or even more. They're not considered high risk, so they don't need PMI. They can still get funding without having PMI. So they don't need extra insurance in case they default, because they're showing they can put some skin in the game. So that's something you would really want to pay attention to, because even in the future, when you pay your loan down, you can refinance and remove PMI, which makes your payment lower also. Once you secure funding, let's say you're pre-approved, you want to pay attention to your closed cost estimate, and all the different fees you're going to be paying throughout the process and at the end at the table, which are your closing costs, your actual closing costs. Those fees are very important because there's a lot of different fees that you don't want to be blindsided by. And sometimes you might pay for your appraisal, your title, and all these different things throughout. And that actually is being removed from your closing costs. So you want to keep track as you go. Okay, now that I paid my title fee, or I paid my appraisal, my inspection, let's remove those numbers from your closing costs and see what it is now, like, updating it as you go and talking to your lender as you go to see what the details of what your closing costs are going to be as you go on, and just keeping your mind fresh on it and getting the knowledge on what is each term that you're paying for. You don't want to pay for something that you're not sure. A lot of people just sign off and trust their lenders or even their real estate agent, but you should be able to ask questions and ask a million questions until you're clear on what you're doing, and so that way you're comfortable with what you're doing. So overall, the goal is just understanding your financing. This was just some brief tips and some brief insight on what a mortgage is, the different things to obtain it. Again, you want your credit score to be pretty strong, you want your income to be good, you want to save up money. So overall, just really pay attention to the numbers on your closing cost estimate sheet. If you don't know what that is, ask your lender, they should be able to provide you one. And then any other questions, if you feel free to shoot me an email, a comment below, let me know what you're thinking. Let me know if you have any questions in reference to real estate finance or anything about real estate, period. Thank you.